I'm not near as tall as everybody else, so I'm going to have to get this down. And um, oh, hey Tim, can you get my slideshow up? So, like you said, my name's David Martineau, second generation oil guy. My core is I'm a production engineer that ultimately got into the financing world about 7 or 8 years ago. And I really want to talk about the sub $100 million space and how you finance things and how we go about doing things. As BJ told you, lots of deals happen in the mineral and non-op space, but a lot of those are really done by groups that already have their financing in place. They have a fund and they can trigger. Most of what we do is we deal with folks that need financing and trying to find out where we ultimately hang out. So, still waiting on the slide? Okay. This is going to be a really short speech if I don't have those slides. Yeah. Well, thank you for that. Tim, we getting there? Little difficulty. Okay. Hey, would you get my phone? Yeah. So guys, I'm gonna try to do this from my phone and starting the speech here. So what's driving the sub $100 million space? There's lots of activity. You see lots of deals, right? And we have the mega mergers you see happening, right? We're in full trickle down effect. What happens at the high level ultimately gets to the mid and then gets to the sub $100 million space, right? Traditional holders of small deals sometimes have focus elsewhere and they want to put their project out to the marketplace. Sometimes guys put their deal out there looking for the flyer out there and hopefully they can get a good price. If not, they pull their deal back. A lot of opportunities we're seeing right now. You've got groups that are trying to be ESG, right? And big groups trying to say we're ESG, and we're going to talk a little bit about ESG here in a second. But they're putting focus on different areas and ultimately feeds the A&D market for both minerals and non-op and operated for that matter. Also, what we're seeing is we see a lot of deals go, and you're starting to see sellers get deal fatigue. They're not getting their numbers that they want. They're getting their numbers, and then the deal can't close. And so we're seeing lots of opportunities as the operators or owners of these assets really try to understand where is the right balance for a sub $100 million space, right? And there's really kind of two subsections in the sub $100 million space. Hey, there we go. Hey, nice. All right. Oh, there's the lawyer disclaimer. Everybody read it real fast. Okay. So as I was saying, right, you're starting to see sellers get deal fatigue because they're not seeing the closings that they want. Also, you're seeing the absence of capital. When a deal fails, we're seeing round two opportunities to come back. That the deal shows back up 90, 120, 180 days later. In some cases, we've seen the same deal 5 or 6 times. And the seller is just damn near hell-bent to try to get a number, and he's not paying attention to the price of natural gas, and he's still trying to sell, right? And so when we're looking at deals, we, as Tim said, we're a PDP-heavy group. We love our cash flow. It's kind of our North Star, as we like to say. But out there in the world, outside of the Permian, the Permian still gets the premium, right? We've talked about it. We know that's the case. We know that people are getting better multiples. Most of these multiples that I have here are outside of the Permian. So we're seeing deals trade in the non-op space anywhere from a cash flow model of 2.2 to 2.7x on free cash flow annualized. And then in the royalty space, we're seeing 3.5 to 5. Now, the royalty space, of course, has their own issue because if you're buying something and you're in a 20-year hold, right? Most non-op players aren't in a 20-year hold. They're trying to find their returns and then push it back out. As we're a mineral operator or mineral buyer, depending on what their model is, they're wanting to see a long time hold. So they're willing to pay more. Most of these are cash flow driven. We have issues out there where you're buying, as BJ called it, line of sight. I just call it near term, right? Things that are getting drilled, right? And when do you get into the cash flow? When do you get the division order? When do you start seeing this happen, right? So here are some headwinds that we show. If you do not already have your capital lined up, you have a hard time finding capital. It just is. That lack of capital, right? If you have a fund or you're backed by a family office, okay, you have the capital and you can go and purchase. If you're out there looking for a deal, most of the time, BJ wants to know, as a seller, he wants to know you have your financing in place before you put the bid in. But that's not always the case, right? A lot of people go get the deal and then start looking for their financing. Kind of is a troubling time. We see a large disparity here, some headwinds out there in the market. We still see a disparity of the bid-ask spread. We see the sellers get stars in their eyes. They get a bid. It's a good bid. They want to hit the bid. And then the buyer can't finance it and get it done. And so, but then you go back to that seller a second time, and they're like, but I got that number before. And it's like, well, that's not a real number because the guy couldn't close. It's only a real number if he can close. And so when you start looking at financing, right, in the old days, you could country club a deal. You could go out there and get some money. Listen, my father drilled 3,000 wells in his career, and he country clubbed almost every one of them, right? Country clubbing deals is dead. You can't go out there and do that. It just doesn't work right now, right? And there's very few senior lenders in the space. If you find a senior lender in the sub $100 million space, they're going to be at 50 to 55% LTV, right? So that means you've got to bring 40 to 50% equity to the game. Well, all of a sudden now your equity returns start looking a little wonky when you're used to thinking, hey, I could maybe get 70 or 80% of a loan and I can put 20% down in equity. Now you're closer to 50-50 or 55-45. Makes it a little harder, more headwinds. The big equity shops, they don't really want to play in the $100 million space. Some of them will. We'll let your guys dip down in there, especially in the mineral space. NonOp, if you have the fund, you can do it. But the big equity shops, the ones that are still playing out there, they don't want to be in the sub $100 million space. I said this on the first slide, and I say it on the second slide of advantages and challenges, is the sellers are getting deal fatigue for lack of closing. It's a good opportunity, but it's also a bad thing, right? Also, when you start looking at how do you find your returns, and you say, hey, I want to start hedging, right? All of a sudden now, that hedge position that you're looking for the counterparty, they see that as a risk factor, and you're dealing with their credit group. And they're putting a cost, what should be a costless cost, a swap or a costless collar, you're now seeing a cost associated with that. Now you got to bake that into your economics as well, because you're seeing that they don't want that type of exposure. They've been burnt. They want big groups that are happy to come in. So the guys don't want to take that. And so when they do take it, they're going to charge you a premium to even just do a straight swap. Also, when you're buying your non-op, in particular, this bullet point is a non-op one, you got to make sure you have enough capital to hit the CapEx, right? I mean, we've financed quite a few non-ops. Within the first month, we saw 5 or 6 AFEs come in the door, and all of a sudden our cash flow model goes on its ear. So you've got to make sure you understand who you're dealing with and how fast are these AFEs coming. What's that CapEx looking like? And the same on the mineral side, if you're buying it and you think they're drilling it, right? How long is the space? How long is the time to develop it, right? We bought a mineral package 2 years ago that had 4 wells being drilled and completed. 2 were already drilled, 2 were finishing, and it took 18 months to get us into pay status, right? I mean, we've all seen that. And so what happens is now all of a sudden you buy something and you think you're going to be in pay status in 6 months, and now you're in 18 months. Now all of a sudden your returns are kind of wonky. And so now we're starting to look at, hey, we need a delay in cash flow. And so we're starting to model these delays just because even though they're good operators and they drill good wells, they're kind of taking the Chesapeake model a little bit, where they kind of hold the cash flow for a little bit and kind of pay their vendors, right? And so we've got to make sure that all of a sudden we have the timing works, and you got to know your groups, you got to know your operators. Even if you're non-op or mineral, you got to know your operators. So same kind of slide here. We're in know your operator. They asked me to put a little ESG and energy transition slant on this. The most important thing when you're a mineral owner or you're a non-op owner, right? Know who your group is, right? There's three kind of groups in the ESG and energy transition space, right? You got your progressive, which are going green and greener and doing everything they can to get there, right? They're ideologically driven, right? They are about big investments and they want good results. Are they getting them? We'll talk about that later. The next group is your conformist. Those are the groups that are just doing the minimal amount to get the press release that say they're ESG, they're green, and they're moving on, right? And then you got the last group, the traditionalist, right? The go woke, go broke group. We're about returns. We want to drill wells, we're about returns, right? Where does your operator, when you own minerals and you're non-op, where does your operator fall on this category? Because if they fall in different categories that don't work for you, all of a sudden your cost structure is going up. Because if they're spending money on green projects that ultimately get tagged to your well or your asset, you're paying for things that you might not want. So now I'm gonna step into the little bit of the advertisement for EnRes and Finergy. We basically have two buckets of money. I have an 80-person or 80-entity family office network that has a net worth of about $17 billion. They are our equity providers. When we go out and we find a deal and we need an equity slug, we go out to this group. We've oversubscribed for the last 10 years. They are with us and have been just keep going. Our model to them is we push out quarterly distributions. And so they're seeing immediate returns on their investment. It's not like a real estate where you're going to go buy a deal and hope you get something back in 5 years, right? Our second bucket of cash is Finergy Capital, which is a debt fund that's backed by Israeli investors of $120 million. And then we have a soft commitment of another $120 million behind that. This is a completely debt fund. Primary, we love VPPs, but we'll do debt. This is in the debt fund, we give very little value to PUD or upside. This is a PDP, strong, heavy debt component. Now, the beauty of Finergy compared to a senior debt position is we will push the LTVs up to 75, 80, 85%. We actually did a deal about 5 years ago that we were at 97% LTV. It was a great deal. It was a great buy, and we did the deal. Here's just a handful of deals we've done in the last few years. We've deployed about $100 million across all the boundaries. 2 non-op, 2 op, no mineral deal in here. I'm sorry to the mineral guys here. But we basically right-size our debt, and we push out nice returns to our equity investors. And you can see the estimated returns at closing for our equity provider is in the 20% range, which is what you want, right? Am I there? Yeah. So, how do you go find the deal? What do you do, right? You can watch everything that the marketing guys put out there, and you can chase everyone. But the most important thing when you're in the sub-$100 million space is you really got to leverage your network. You got to go find a deal that's not on the market, right? And work that deal, right? You can chase the deals on the market. That's fine. But most of the time, they pay a little bit more than you go find the other one, right? So leveraging your technical team is very important as well. So leverage your network, leverage your team, right? Evaluate things, know the deal better than the seller, because many, many times the seller is just wanting to move on in a different direction, and this has been a non-core asset for them. And there are lots of little nuggets kind of hanging out in there, right? Now for us, we are a PDP. We love our cash flow. So we like to see almost 80% of all deals in the PDP range when we finance them, because we want to see the cash flow, we want to see those returns, right? We always use a third-party engineering. We have technical guys in-house, but we always go out and get a third-party engineering group, right? We're seeing the target on PDP of NonOp north of PV20, PDP of minerals PV 15 to 17, right? So you kind of see the difference. Now, minerals not all minerals are made equal, right? Because if there's a big drilling component that you want to get into, you want to try to get in front of the bit. So while I tell you it's a PV 13 to 17, right? You might have to pay PV 10 because you have such a big runway out there, right? Usually that's not a project that Energy or Finergy or NRes is going to do, because we like to see our PDP, right? Also, know your development plan, right? I touched on it earlier. We really have to make sure that if you're in the non-op position and you have to have a CapEx component, you've got the capital to meet your CapEx requirements. You're going to be talking back to BJ to sell the AFEs, right? Or go through that route, right? I like to make sure that when we've bought an asset, that we get to develop it all the way, even if it's a farm out, instead of just selling it. Last thing, if you know you're going to have a big CapEx component, put that alternative financing in place. Be ready for those numbers to come in, right? That's really, really important. Also, you want to right size your debt. If the project can handle a mezz type debt that's at 85 or 90%, is it really the right deal? Is it the right financing? How many of us in this room, I probably could raise everybody's hand, how many people have seen a great deal that has a horrible financing structure, right? And it just kills the damn deal. And so what you want to do is you want to make sure that if you're using an RBL, you're using a term loan, and you're starting to see these senior providers just do term loans, right? And it's not really an RBL anymore. It's a cash flow model. When banks are lending now, they're lending on cash flow models. And they love the 3, 4, 5 year term loan. Also the volumetric production payment. In the old days, you could hear about Chesapeake doing them for 15 or 20 years with Deutsche Bank, and they crapped out after 7. Most of the VPPs done now are within 3 to 5 years. Again, target your debt. Try to keep it at a reasonable amount, even though it might hit your equity returns a smidge, right? And then the last thing is here, and you really have to actively hedge your production. You must hedge your production to see returns. The volatility in the market, up, down, all around, we've all lived it. If you are constantly building a hedge program, what we like to do is we like to always have 2 years hedged out, maybe 50 to 70% of our production hedged for 2 years. 1 quarter rolls off, we add a quarter behind it. And so we're always hedged. We always know where our returns are going to be. So you want your hedging to really save you when things dropped out. I'll tell you a quick story and then I'll call it a day. We did a deal in September 2019. Of course, 2020, COVID hit. Price went negative. We all know that horror story. One of our investors calls us the next day and goes, well, I guess we just lost all our money. And it's like, no, we have hedges at $32 here. And it basically, that hedge took us through that black swan event of a horrible volatility. Now, we're still seeing volatility in the market, so we want to see our hedges. So that's about all I have to say. I thank you very much. I'll entertain any questions. Appreciate it. Yes, sir. So the question was, if you, at a senior position, at 50% LTV, and then you actually get an alternative debt structure that's maybe 80 or 85% LTV, what does the interest rate look like, right? So you're seeing some banks, traditional lenders, senior lenders, 9.5 to 11% right now. If you go to 85%, you're at 15, 16, 17% cost of capital, right? Now, listen, that's not a bad thing. especially if you can refi it out, right? If you use it to get the deal, get it controlled, and then in a year, most of these people will lock you up for a year, right? They won't let you just flip you out in 3 months, but let you lock it up for a year, you pay the piper for a little bit, and then you get into a traditional debt structure. Any other questions? Yes. How do I evaluate ESG risk? So when we're evaluating a property and we're looking at our operator, right, we ultimately want to see what they're doing. And so we just have to go into the public market. We have to see what their ESG mindset is, right? Because you can go, we can go talk about all the majors and all the super independents, as I like to call them, and each one has their own mindset about ESG. Now, a lot of it's washing away now, right? It's just, you just don't hear about it much anymore, right? At the KeyBank breakfast this morning, the guy said, I don't even hear about ESG anymore. But ultimately, when we want to look at it, we want to ask the operator who we're buying things from, give us the AFEs from that other group, and is there an ESG component kind of hidden in that deal, right? And this is for the non-op side of things. In the mineral side, you just really have to go through the public realms to kind of dig on your operator. All right. Any other questions? Well, it's been a pleasure. Tim, thank you for inviting me to speak. I appreciate it. Y'all have a great rest of the NAPE. That's Beer 30. Let's go.